By way of introductions, I'm Angela McCulloch and I'm a partner in our personal and family team. Today's topic is based on a growing awareness of environmental and social issues that have caused many people to consider where their money is being invested and the impact of their investment choices. Later this year, Glasgow will host COP26, which is bringing parties together to accelerate actions towards the goals of the Paris Agreement and the UN Framework Convention on Climate Change. On his first day in office, President Biden rejoined the Paris Climate Accord and has signed an executive order cancelling the Keystone XL pipeline and directing agencies to review and reverse more than 100 Trump actions on the environment. And for those who watched Sir David Attenborough's Perfect Planet and saw humans as the world's newest force of nature alongside volcanoes, the sun, weather, and the oceans, it is clear that there are challenges for us all. But there still remains hope. Sir David said, "Human activity is now so dominant that it is disrupting the forces of nature and the vital habitats life needs to survive on Earth. To preserve our planet, we need to act now. And if we do that, there will still be time to restore the ecological balance that once made this Earth our perfect planet." As we are all more conscious of our impact on the world around us, Nordic bank Nordea's sustainable finance team carried out an analysis that showed moving your pension savings to sustainable funds can be 20 times more efficient than the other measures which were suggested in their study to reduce your carbon footprint. And the other measures they had suggested included things like shortening your showers by 2 minutes each time, taking one less international flight per year, taking the train instead of the car, and eating only one piece of meat each week. And on that note, I am delighted to welcome Leslie Gent, Head of Responsible Investing at Coutts, and John David, Head of Rathbone Greenbank Investments, to join me today. Leslie, could I start by asking you to introduce yourself and provide some background to your company? And John, could I then ask you to do the same?
Great. Thank you, Angela, and good afternoon, everyone. I'm Leslie Gent. I'm Head of Responsible Investing at Coutts, and just some background. Coutts is a UK-based wealth manager. I suppose relevant to this conversation, the asset management group within Coutts has been focused on responsible investing with intent, I would say, since 2016. And really, we've been on this journey of learning about how to integrate this and how to move our portfolios to be better for obviously our client base, but also for the planet that we live on. So yeah, that's kind of a quick summary of Coutts and Coutts Asset Management. John, maybe over to you.
Thank you, Leslie. So I'm John David, and as Angela has noted, I'm head of Rathbone Greenbank Investments, which for those of you who've not come across us before, we're the specialist ethical, sustainable and impact business within Rathbones. Rathbones itself is a FTSE 250 wealth manager with around 50 billion under management. And again, our focus on responsible investment as a wider corporate has been growing over the years. We are a long-term signatory of the UN Principles for Responsible Investment, and we've been a very active investor in terms of engagement with the corporate world in endeavouring to bring about positive corporate change. So with particular activities around issues such as modern slavery. Greenbank is slightly unusual perhaps in the marketplace because we have focused on this area for 20 years. We describe ourselves as ethical, sustainable and impact investors, and I'm sure we'll come on to the terminology a bit later. But perhaps where we differ from the mainstream is that it's our sole purpose, and we endeavour to be real pioneers in this space, helping drive the wider change in responsible investment.
Thank you very much, John and Leslie. I think that probably leads into the very first question I have. And John, if I could possibly direct this one to you, could you just tell us what the history of sustainable investment is?
I can give it a go in a nutshell. So I've specialised in this field for 20 years. But I really can't claim to have been in at the start of sustainable investment, because its roots go back a couple of centuries, really to the 19th and early 20th century, really led by religious orders, particularly the Methodists and the Quakers, where there was a concern that in investing in businesses, financial markets, there could potentially be a conflict with Quaker or Methodist values. And so they imposed stringent exclusions on areas like alcohol, gambling, for example. So that's what we might refer to as negative screening, so screening out investments of concern. But then over the 20th century, we saw the concept of ethical investing expanding, particularly developing a greater interest in what we might call green issues, whether that's climate change, even 50 years ago, frankly, or in areas like the use of chemicals in pesticides or even fertilizers. But we also see the development of social issues, particularly through eras such as the apartheid era in South Africa and through the Vietnam War, where increasingly there was a cohort of investors who wanted to exclude areas of concern. But more recently, we have seen an expansion of focus within this area to cover a very wide range of environmental, social, and governance factors, and not just from an exclusion perspective, but also from an inclusion or positive investment perspective. So coming to that point about investing with intent that Leslie has already touched on. Most recently, we have seen the emergence of the term impact investment. And again, hopefully we'll have a chance to come back to some of the terms, but this is where the benefit of investment is not coincidental. It is wholly intentional and measurable. But it is increasingly one of those words that is perhaps a little misused. So perhaps we can tidy up some of the terminology as we go through.
Oh, thank you. That's an incredibly helpful overview. And I think it's got a much longer history than many of us would have fully appreciated. Leslie, could you possibly explain to us what the main drivers for this are now?
Yeah, definitely. I think if we sort of split it up into, I suppose, supply and demand, because that typically is what leads to growth of new ideas. I think what we're seeing in the demand space, and you referred to all of the work that Sir David Attenborough is doing to sort of shine a light on, for example, climate change. But I think what we're seeing in the media, on the front page of our newspapers, we're just seeing more and more information about these topics that are related to environmental issues, social issues, governance issues. So whether that's human rights related, whether it's about diversity, we had the Black Lives Matter movement. I mean, these are all things that all of us are becoming more and more familiar with. And so as consumers, we're becoming more aware, but equally as investors, I think that awareness is leading to increase in demand. And interestingly, we've done a few surveys, and obviously within the industry, there are lots of surveys done just to try to gauge investor demand. But certainly some of the work that we did last year, asking some of our clients about this topic, clearly over 60% want to learn more. So they just want to have a conversation, maybe with their financial advisor, to understand what ESG means, what responsible means, what it means to be sustainable. 80% believe that companies that consider ESG issues will perform better. So again, debunking that myth that somehow investing in a sustainable way might be detrimental to returns. Basically, investors are saying, I don't believe that. And interestingly, around 50% are saying that they are considering increasing their allocation to sort of ESG strategies over the next 3 years. So the demand in terms of the feedback that we're getting from clients is definitely there. But equally, if we look at what's going on in fund flows, and that's kind of the data that's most publicly available, we're seeing really huge growth in this area. For example, Q3 2020, this is, I think, according to Morningstar, they do a lot of analysis on fund flows. 40% of all flows into funds in Q3, 40% went into ESG or sustainable funds. So a fund that is in some way badged sustainable. That really shows you that not only is the demand there, but this is moving very, very quickly from being sort of niche into mainstream. So the demand side is definitely there and growing. And then if we look at the sort of supply side, I think you see regulation in a sense probably moving that the most. And certainly the European sort of sustainable finance regulation has done quite a bit to help, I suppose, raise the awareness with all asset managers, maybe not those that have been focused on this for 20 years or 10 years, but maybe those that have been a little bit reticent to investigate this topic. But regulation will push the whole industry, I think, to sort of minimum standards when it comes to what ESG means and the integration of that. So definitely on the supply side, we're seeing regulation help move that momentum. I think also sort of the academic literature, the investment in knowledge that a lot of investment professionals are doing means that a lot more of them believe that this is the right way to invest, that it isn't just about the bottom line, it's also about some of the non-financial impacts of investing. So I think those are driving supply. But then let me go back and just quote some numbers also, because it's helpful to understand how the supply is also expanding. Again, this was from a similar report from Morningstar, and it relates to Q3 2020. And there were 166 new fund launches that, again, had a sustainable objective. That's really an unprecedented amount of new product coming into the market. So, I do think that is being driven by regulation. So asset managers realizing maybe they don't have product that meets some of the sort of the requirements that will be coming over the next few years. But 166 new products, and I think there were 32 funds that were rebranded as sort of ESG or sustainable. So quite a bit is happening on both the supply and the demand side. And I suppose the other thing that we should think about is what's happening within the financial system. This sort of historical focus on profit, bottom line, shareholder primacy, short-termism, that sort of pendulum of sort of profit and only profit, and it doesn't matter what the impact, I think that pendulum is shifting so that there's a better sort of balance between profit and purpose. And so I think that's kind of the other big trend or driver that is really encouraging adoption of responsible investing or sustainable investing.
Oh, certainly, with the numbers you're mentioning there, it does sound like it's much more mainstream than possibly previously even understood. And I suppose, John, if I could maybe come to you on this one, what does that mean for investment approaches that are available to investors? Is there really quite a wide variety now? Because I think previously you might have thought that actually if you were looking to go into sustainable investments, it was maybe a more limited market.
Yes, I think you're right. I think there is a much greater range of opportunities now. But I think also that caters to the fact that there need to be a wide range of approaches. There's not a one size fits all to sustainable investment. So, it might be that some investors are more motivated by the financial factors that Leslie touched on. So looking at environmental, social and governance factors as a way to identify potential risks and potential opportunities. And to me, that's absolutely fine if in the process it encourages better corporate behavior on those ESG factors, then we're all moving in the right direction. But equally, there are still, or in fact, there's a growing cohort of clients who are looking to reflect their values more clearly in their investments. So perhaps clients who in their daily life think about what they eat, how they travel, what they buy, and suddenly making the connection to the sorts of companies in their portfolio that actually they just wouldn't touch in their day-to-day lives, and they're making that connection between how they lead their lives and how they want to invest. So I think that values element is still quite important. And some clients, of course, still have very specific ethical criteria behind their choices, and it's not for any of us to say whether issues like, you know, arms or alcohol or tobacco are necessarily wrong or right. It's down to a personal preference and personal choice. And increasingly, the investment markets are able to cater to these choices more completely across the whole range of asset classes. But I think that the biggest move that we've seen is this desire for a more sustainable planet. And again, Leslie's talked about this a little bit. There's a lot of comment in financial press at the moment about a generational transfer of wealth that is happening, and a sense that in younger generations in particular, real concerns about the future of life on this planet are starting to bear on how they invest their money. And I think maybe a realization that perhaps some of these issues that, I don't know, 10 years ago we thought might pose a challenge in 50 years' time are now rather more on our doorstep. So thinking of climate change in particular. So the range of approaches that people can take are often described on what's known as the spectrum of capital, where you have your more traditional approaches to investment on the left-hand side. So that's really a prime concern on financial return with very little, if any, consideration of ESG factors, to full-on philanthropy at the other end of the spectrum, where it's all about having a positive social or environmental impact with no desire for financial return. But as we move up through that spectrum, we see subtle differences across areas like responsible investment, where the focus is on ESG risk and opportunity, on sustainable investment, where really we're looking at companies who are operating in a way that promotes sustainable development within the wider world, and that could be both through the way in which they operate their company or through the products and services they provide, to thematic investment, where really we're looking at investments in companies who are solving social or environmental challenges specifically, and then finally to impact-driven investment, which was a term I mentioned earlier. And I think this is really where we're talking about companies who are in existence specifically to address social or environmental challenges. And it's at this point of the spectrum where there is potentially a trade-off between social and environmental return and financial return. So clearly not something for everyone, but it is a growing segment of the market and something that I think we will see increasingly within portfolios. But I think the key here is that it's a complex area and the lines are blurred. And I think we all have a duty to our clients to listen to how they would like to see their money invested, and then advise them on the implications of that approach, both positive and negative. There will be different views. So if we take a couple of examples, so let's take nuclear power. If you speak to 100 environmentalists, it'll probably be split fairly clearly down the middle between those who see nuclear power as being a solution to the climate risk problems, or part of the solution, to those who feel that the environmental risks are just too great. So there's no one size fits all, as I say. Similarly, on the issue of fossil fuels, and I'm sure we'll come on and talk about engagement during the course of today, some investors would say, look, we still need fossil fuels in our energy mix. We will have a much greater impact as investors if we remain invested in these companies and exercise our rights as shareholders to encourage management teams to change the direction of companies to take account of climate risks through our voting. Whereas others might say, do you know what, I just simply don't want to be invested in fossil fuels. There are so many opportunities now in renewables that is how I would like to express my views around investment.
Oh, thank you. And again, it just shows how much needs to be considered, but that the different approaches can be tailored. I suppose, Leslie, if I can come back to you, and I suppose it's been a theme that's coming throughout the discussion today already, and it is the influence or the impact that the climate crisis is having on this. I mean, how do you feel the sector is being influenced by the climate crisis? And I suppose just the increased levels of publicity, because we've already mentioned Sir David Attenborough, but he has been hugely influential in really raising awareness across the board.
Yeah, absolutely. I think the industry is, I kind of hesitate how I say this, but for me, I think in 2019, the industry sort of woke up, sort of everyone woke up, as opposed to sort of the more active investors who always have seen this as an issue and have been actively managing it. But I really feels like, and I don't know why 2019, but just for me, you know, as I kind of observed things, it really felt like the industry acknowledged that climate risk is something that needs to be considered across all portfolios. You know, John was talking about the different styles of sustainability and that spectrum. But, you know, whether you consider yourself a responsible investor or not, I think a lot of asset managers acknowledge that this is now a risk that needs to be well planned out, well thought out, and, you know, a strategy put in place to mitigate that. And it's interesting because, you know, we, within our portfolios, we invest with a lot of different asset managers. Some of those are, you know, very strong when it comes to sort of responsible investing. And then you have some that are just sort of, again, just starting their journey. But it is interesting to me how many of them are now talking about their plans to mitigate transition risk and physical risk within their portfolios. They're talking about sort of stress testing for various degrees of climate warming. So they're really starting to look at their process and think about these risks and build out, I suppose, their methodology or their approach for how they're going to assess and mitigate it. So there, you know, it does feel like climate change and the risks associated with it are being acknowledged in the industry. However, I would say, you know, we shouldn't be complacent. I think we're just starting, and certainly more needs to be done. You know, when we look at, you know, given sort of current policies and laws and regulations that are in force across the globe, we're still essentially on track for anywhere between 2 degrees and 4 degrees warming. It depends which study you look at, it depends which analysis you use, but let's just call it 3 degrees of warming, which we all know is unacceptable and unsustainable. But what's interesting is sort of to bring it to that sort of acceptable warming number of 1.5 degrees Celsius, it will require 2 to 3 trillion of investment per annum, which is a really big number, right? The current run rate, I believe, is around 500 billion. So you can see we're still a long ways off from that. But what's interesting is for me, I just see that as a really massive opportunity that, you know, if this is really going to grow, it has to grow in order to solve the problem. And the financial sector is at the heart of really driving the solutions and financing the solutions ultimately. So I think there's a lot of promise in terms of what will happen in the financing. I suppose the other thing that you're seeing in the industry, aside from sort of acknowledging the issues and sort of planning for how to mitigate those, you're also seeing asset managers work together. John talked about sort of stewardship, sort of the engagement that happens at companies and voting, but that engagement seems to be happening more and more in a collaborative way, so that asset managers sort of come together through initiatives such as Climate Action 100+. I think John also referred to UNPRI, again, a global initiative really to enhance and improve ESG investing across the globe. But there are all these collaborative initiatives. And I think, again, that's really quite a good thing for this industry, that we're coming together to solve the problem. So, you know, I see a lot of things happening and a lot of really positive steps. And so the optimist in me goes, yes, we're on the right path. The pessimist in me says, okay, but you know, this is still such a big risk, such a big issue. And the biggest problem with climate change is that it is a risk that will appear over the long term. You know, I mean, COVID is a crisis that's happening right now, and it's a plan that's being put in place. And so you can see how governments are really tackling this crisis, because it's here and it's now and it has to be addressed. Whereas climate change is 10 years, 20 years out. And it is hard to sort of build that momentum and that interest for a risk that is, you know, further out down the road. So I think that's one of the challenges, and it's why we need to stay focused on this topic.
Oh, thank you for that. I mean, John, would you have anything to add on that one? Because again, it's just thinking about it, the climate crisis is huge, and you have your own experiences and what you're seeing in your practice as well.
Yeah, and it's interesting, isn't it? Because one of the challenges of COVID is it's rather taken attention away from the climate crisis, and we've talked about Sir David Attenborough. I don't think we mentioned Greta Thunberg yet, and you know, it really felt like there was momentum building behind climate action, which I think certainly in the first phase of the COVID crisis has perhaps slipped back a little bit. Clearly, we saw the postponement of COP26, which we'll, as you mentioned, see in Glasgow later this year. And I think it's been quite encouraging that there has been more focus coming back to the climate crisis. And clearly, it's had a boost in terms of President Biden's inauguration and re-signing to the Paris Agreement. So good to have the United States back at the table. But I think that one of the big shifts, as Leslie has said, is that corporates themselves, and that's not just within the financial service sector, but within business generally, have started, I think, to really factor these risks into the way in which they are managing their businesses. And it might be on a 10, 20, 30-year view, but you have to start somewhere. And I think we're just starting to see the beginning of a snowball effect of real, genuine, long-term change.
So that certainly sounds sort of very positive messages coming through on the back of that one. I suppose it would be remiss of me not to ask a direct question relating to COVID, given the experiences we've all had over the last year. And I suppose, John, if I could maybe come to you on this one first, what impact has COVID had on the industry, if any, so far?
Yeah, it's been really interesting, actually, and I guess we're probably all looking for positives out of COVID. So I will try and find some. I think for me, you know, having kind of worked in this space for some time, it's been quite interesting that for a long time the mainstream sort of financial world really paid incredibly little attention to ESG factors. And I must admit, I've never quite understood that, because I would have thought that a consideration of a whole range of additional factors should be a way of helping manage risk and identify opportunity. But I think one of the things that really changed attention in this space was the global financial crisis, which ultimately could be described as a failure of governance. And so that G element of ESG really came to the fore over that period. And we've really started to see the financial sector paying much more attention to how companies are governed, and having a much louder voice at the table in terms of voting their shares or their client shares. We then started to see a build-up of interest in environmental matters, particularly linked around climate change. But I think what COVID has brought to the fore is the S of ESG, so the social factors. And I think that through COVID, we've really seen a highlighting of some of the tensions within the world, particularly the disparity between rich and poor, and particularly the impact that COVID has had on many of the less well-off in a society, and the fact that those members of society are absolutely critical to the functioning of society. So key workers such as nurses or teachers or supermarket workers or delivery drivers. And then some of these tensions have bubbled over in other areas. And we've mentioned the Black Lives Matter campaign. But I think just generally, we've seen a much greater focus on social issues, whether that is gender, sexual orientation, religion or race. And I don't think that we're going to lose that. And then, of course, there's COVID itself. So I think there is widespread agreement that pandemics such as the one we're living through at the moment are likely to become more prevalent as we continue to destroy the biodiversity around us. So man is coming much more into contact with wildlife, which could be carrying dangerous pathogens. And there is a real fear that as we continue to strip rainforests and destroy large swathes of our planet, problems such as COVID are going to come to the fore. And I think more generally, perhaps there has been an acknowledgement that life is quite fragile. Perhaps we've taken everything very much for granted in the past, and people are just slightly starting to think, what do we want the world to look like post COVID? And I think that's touching on all aspects of ESG.
Thank you. Leslie, would you have anything you wanted to add on that? I mean, that was a sort of very comprehensive look at how COVID is impacting things, but I suppose it's impacted every single aspect of daily life as we knew it, of corporate life as we knew it.
Yeah, absolutely. I mean, we've all sort of had to rethink, in a sense, priorities. I mean, I would just agree with what John has said. I think he said it very well, so I'm not sure I can add much, but certainly the focus on some of the social issues, I think that's been really welcome. As sort of ESG has evolved, in a sense, governance was something you could easily get your head around. Environmental issues was also equally, you could sort of see the framework developing. But the framework around managing, social issues hadn't really been as well developed. And I think in a sense, COVID has helped focus our attention on the importance of building a strong framework around social issues, whether that's human rights or how you treat your workforce.
Thank you. And I suppose just moving on from the sort of the governance and the frameworks that you would use, typically frameworks come in the form of regulations, and it certainly seems that regulation is playing a much bigger part in our lives than ever before. I think that between them, the UK and the Scottish governments have passed 380 different regulations and orders in response to the pandemic. And I think just in sort of my daily practice, I see regulation far more, and that is coming just from trying to open up bank accounts for clients and dealing with investment products, right through to the international treaties that have been put in place to encourage the automatic exchange of tax information, and then everything that arises from that. I mean, Leslie, if I maybe come to you on this one first, do you think regulation is shaping the investment world in the future? And I suppose, do you think that the prominence of issues like addressing climate change, and I suppose that seeing that is now much higher up on the sort of world's political agenda, is that going to lead to even more regulation? And if so, what does that actually mean for businesses and investors?
Yeah, definitely. I think the regulation has increased, or certainly it feels like it in my day job, and the amount of sort of regulatory change that we need to put into our business to ensure that we're complying with these rules, and as you say, the framework. So it's definitely growing. I mean, I always say, sort of as a caveat, regulation is there possibly because the industry hasn't been as transparent as they need to be. And to me, that's really what regulation is. It's about transparency, and it's about being clear about what you're doing, why you're doing it, and how you're doing it. So without a doubt, I think there's an increase in regulation. And I'll just say anecdotally, within our business, we have this. I suppose it's just a meeting that's called the Upstream Risk Forum, and basically what it is we get together every Friday. It's a very exciting meeting, but just to talk about sort of new regulations that that have come through in that week, and it's really amazing when you see just how big that spreadsheet is every single week. Now, often things carry over because it takes quite a long time for a regulation to come into play, but it is, there is a very strong focus. You referred to climate change. I was looking at a website, and I'm going to forget the name of it now, but basically they track sort of laws and policies that have gone into effect globally linked to climate change. And I think there's something over 2,000 were put into place in 2020. So this need to, I suppose, be clearer to all of the players around what you need to do inevitably comes through either in policy or laws or regulations. So yeah, it is definitely increasing. It is sometimes difficult to keep up with the pace, but some of these are important. I mean, I referred earlier to the EU Sustainable Finance Regulation. There are lots of different layers. A lot of it comes into play over the next sort of 2 to 3 years. But equally, the FCA, obviously we're not part of Europe anymore, so those regulations technically don't apply. But we have heard or had strong hints from the FCA anyway that they certainly intend to put in place something similar, if not something more robust than what the EU has already established. And even for investors who have a strong framework in place, who have tried to be as transparent as possible, there is a lot of work that needs to go into place to actually comply and to make sure that you have those proper disclosures publicly available so everyone can see them. So there's a lot going on in this space and keeping us all busy. John, I'd be interested to hear how it feels from your perspective.
Yeah, I think, I think regulation in the space is a good thing. I think, everyone probably needs a little bit of carrot and stick. I think one area where it will be quite helpful is in bringing a bit more clarity to the terminology that we use in this space to make it easier for investors to know, what to expect when they make an investment in a product or service labeled as an impact fund or a ESG integrated fund or an engagement fund or whatever it might be. And I think it will also be quite helpful in reducing the risk of greenwash. And I think that is still a danger at the moment. It's very easy, isn't it, to attribute a level of positive impact to any company or investment, but you have to see it in the round. You have to balance it against the negative impacts that company might have. So I think it certainly has a place to play. I think the amendments to MiFID II coming in at the end of this year that will require wealth managers and financial advisors to assess their client sustainability preferences will really help drive this part of the industry forward. And ultimately will give clients much more choice and control on how their money is invested, which I think is a good thing.
Thank you very much. I think we do have quite a few questions, so I would actually move on to the Q&A session. We do have a good 15 or so minutes left, so I would encourage anyone else that's got more questions to send them through on the Q&A section. But John, you your last answer actually touched on one of the questions that we have, and it's coming around to greenwashing. So this, I think, is a term that certainly from my research seems to have been around from the 1980s, and it's generally been used to describe the sort of the corporate practice of making diverting sustainability claims to sort of cover a questionable environmental record, possibly. What does that mean in 2021, and is there anything that the industry can do to prevent it?
Yeah, it's still very much a risk, and it's still very much present. I would like to think the dangers are receding. I think many companies are increasingly aware of the benefits to their business of taking a more sustainable approach to the way in which they conduct their business, and understand the issues far more. And it's quite interesting, if I had phoned up a company 10 or 15 years ago and said, can I speak to somebody about sustainability, either, nobody would have been able to field the call, or if I was lucky, I might have gone through to the corporate responsibility or more likely the PR department. Whereas now, if you phone up a company with a question about sustainability, they probably have a head of sustainable strategy, or you'll go through to the head of strategy. It's much more at the heart of companies. And I think companies are much more nervous about overplaying their hand now. I think with the power of social media, reputational risk from making false claims is very dangerous. And I think the same in financial markets. I think sometimes issues of greenwash come about more through a lack of understanding of the issues or a misinterpretation, rather than sort of conscious effort to mislead investors. Maybe I'm being kind, but I think the world is moving on, and there are some really class-leading companies out there in terms of their sustainability strategies, and similarly investment houses who really do take this to the core of their proposition.
Thank you. Now, we've got a few questions along a very similar theme at the moment that are coming through, and this is regarding what benchmarks there might be for ESG, and whether or not there's any certification bodies that are able to sort of review and certify investments to show that they're actually meeting a sort of minimum standard, or is there a system that can be used to rank funds based on their ESG practices? Could I maybe go to you, Leslie, on that one first, and then John, you can add in anything else that you'd want to.
So there are sustainability frameworks, or sort of labeling frameworks. The only problem with them right now is they tend to be defined sort of country by country. So we still don't seem to have a uniform sort of rating label on responsible investing. But obviously there's momentum, and there's a desire for this to be a bit more cohesive, I suppose, across the various countries. So there's definitely work on that. I think this idea of where could you go to get a list of sort of ESG or a ranking of that. So you have lots of data providers in this space, and really a lot. MSCI is one, Sustainalytics is another. A lot of them are being acquired, so I was going to go with Vigeo Iris, but I think they may well have been acquired by someone. But what they're doing, for example, I think Morningstar uses Sustainalytics, and through that sort of ESG data feed, they are able to rate funds that you could invest in. The problem that you have right now with any of these sort of ratings is there's not a lot of consistency in the methodologies, and not all ratings, you can be quite surprised, for example, that one could say it's quite good, and another one might say it's mediocre. So we don't seem to yet have that kind of consistency of view yet that's out there. But I suppose the way I always sort of rationalize it is, if you go with one provider, at least it's consistent in how it does it. So you could look at it that way. But certainly I think the Morningstar ratings are publicly available, so anyone can go and see it. So I think there are lots of sources of information around all of that. Have I answered all of that, Angela? Or maybe John, you can pick up on whatever I've missed.
I think you probably have. I've maybe got a sort of couple of follow-up questions on that. So it does sound like there's an awful lot out there and there isn't a sort of global standard. Is that something that could be developed by the industry, or is that something that's going to have to come from cooperation against on a sort of global scale, so possibly something that would be looked at as part of COP26 or any of the subsequent or future ones that follow it?
Yeah, I mean, I think it's very much a work in progress. Really, it's the next frontier, if you like, for sustainable investment, because quite rightly, we're all looking for evidence that sustainable investment is delivering what it says it's delivering. And Leslie's mentioned that there's lots of data out there, but it's still fairly inconsistent and incomplete, and it requires human analysis as well. So if we pick a simple measure like carbon emissions, if you had a legal firm or a wealth manager with very high carbon emissions, clearly that's potentially a problem. If you had a public transport with very high carbon emissions, perhaps that isn't such a problem if the net benefit of that public transport company is taking people out of their own cars. So it's rarely as simple as just comparing two sets of data. You really have to understand it as well. But I think we are starting to see global standards coming in. But I think it was last year that 3 sets of new global standards were launched in the same week. So there's a bit of a way to go before we have a true global standard.
Well, thank you. One of the other questions that's come through is the concept and language of natural capital featuring in sustainable investment, and how is it influencing investment behaviour?
I'm pausing to see whether I've got an answer for that one. I certainly see it being addressed, so the language natural capital. I'm just trying to try to bring an example to life here. I might have to pause and reflect. John, do you have anything
I think it's still more of an academic concept than a financial concept. But it's a hugely important concept, and maybe just to put a bit of colour to it, it is extraordinary, isn't it, the value to our lives of water, and yet, do we really pay properly for the use of that water? We think of the value of the Amazon rainforest, described as the lungs of the planet, and yet it's being destroyed because it's just not seen with the capital value that it deserves. But translating that into financial terms for use in financial markets is obviously complex. But I think it is something we will start to see more of in the coming years.
Thank you. Now, one of the other questions that's come through is really looking at accessibility for sustainable investments for those investors who are really just starting out on their investment journey. So they don't have the same degree of capital behind them that they would necessarily use for working with the sort of larger investment houses and having access to these sort of specialist advisors. Do you have any advice for what they could do to make sure that the sort of smaller scale investments are in line with their values and what's important to them?
Well, I'll start, and then John, I'll pass it over to you. Yeah, I mean, I think a lot is happening sort of more in a digital environment as opposed to sort of face-to-face, advice or something like that. But you do see a lot of digital advice where a client can sort of go on to, I tend to use jargon like platform, but you can get lots of information on various funds. There's often very simple investment advice provided to help investors understand sort of their risk tolerance. And then when it comes to sort of responsible investing or sustainable investing, it'll talk very high level about, what matters most to you: environmental risk, social risk, governance risk, to help guide an investor to potentially suitable investments. And a lot of this is available at very low, call it initial subscriptions, in some cases as low as £10. And that's the whole benefit of sort of collective investment vehicles is, everyone piles in, and it means you don't have to have a really big amount of money to start investing. And I think that's really the important point. So I'm kind of diverging from ESG and just talking about the benefits of investing early and consistently throughout your life. But yeah, there's a lot coming on board. Certainly I've seen fund launches, sort of what I'd call multi-asset funds, again, passively managed, but with ESG overlays. So I mean, there are pros and cons of that. I mean, there are pros and cons of every sort of investment approach, but you can do it at a lower price point. Often these products are being offered at 20, 30 basis points, which is a reasonably good value.
I suppose, John, would you have anything to add on that one?
No, I think, that there are lots of multi-asset funds, as Leslie has mentioned, increasingly being launched by a wide range of companies. I think there are also some good websites providing advice on ethical money, and organisations like UCSIF, UKSIF, where they will have links to finance providers, financial advisors, and other useful advice. So that might be a good place to start.
Okay, thank you. Now, John, if I could come to one of the terms that you had touched on right at the start, and it was impact investments. Would you be able to explain what that really means? And because I think that was the one where you said you're at that sort of balancing point where you are you're still looking at getting good returns, but there is possibly a price to pay for those returns to get the impact that you're wanting. So could you maybe just talk to us about that a wee bit more?
Yeah, so I think, as I mentioned right at the start, impact is one of these terms that has developed its own set of meanings, and they're often used a bit interchangeably, which I think is a little bit dangerous. And I think perhaps the best way to see of it is impact is itself on a spectrum where the sort of social and environmental benefits might sit alongside market type financial returns. But there is another end of the impact spectrum where the social and environmental benefit of that investment might outweigh the financial returns. And I think that is an interesting area of the market for some people, for some parts of their portfolio. I think the thing about impact is that it has to be intentional and it has to be measurable. But what that looks like can vary from investment to investment. And there's an organization called the Impact Management Program or Project that rates impact on what they call their ABC model. So where that impact starts at a very low base of avoiding harm to a middle ground of benefiting stakeholders to say the B, and then the C is a contribution to solutions. So you can start to see that spectrum of impact in terms of the effect it is having on a social or environmental problem. I think where we start to see what we might call impact first investment, so that's where perhaps you are giving up some financial return. We're thinking more in the kind of smaller scale enterprise space, perhaps some kind of private markets rather than mainstream finance. And it's been around a long time, but it's taken quite a long time to gain traction. But we are seeing much more interest now, particularly with that generational transfer in wealth, a lot of interest across sort of family office type investors and ultra high net worth, who really want to catalyze positive change rather than see it almost as sort of secondary to their financial returns.
Thank you. Now, I am very conscious of time, but I think we've probably got time for one last question if we've got a reasonably short answer. So Leslie, if I could maybe come to you on this one. Is there an ESG and sustainability bubble?
Oh, good one. I don't know if I've got a quick answer to that. Listen, I think there's a couple things I would just quickly say. I think what we saw during the COVID crisis, when we saw sort of net outflows to investments, obviously the markets were falling and investors were nervous. And so a lot of investors were pulling money out. What we saw there was that the assets were stickier, that typically, and again, I hate to use the word typically because nothing is ever typical in finance, but a lot of people that are currently invested in a sustainable way are doing it because they genuinely want to invest that way. And so, you know, they're there for the long term. You know, all the numbers that I quoted earlier about fund flows and growth, most of that is because there is legitimate demand, and investors will stick with those investments longer term. But it will get frothy at some point. I suspect there will be some money or some investors that are sort of short term in nature, sort of more, as I call it, momentum driven. I suspect that will happen. I don't think we're at that point right now, but it is always important that investors are aware of those kind of bubbles as they appear. I mean, we are all sort of human, and we like to do what everybody else does. So people will tend to pile in if the performance is good, and it has been quite good over the past sort of, certainly the past couple of years, but even if you look longer term, it's been a good investment strategy to follow.
Oh, thank you very much. Well, as we are now very quickly approaching 4 o'clock, I would like to thank everyone who's listened to this webinar for joining us today and for sending across all the questions. We do have a climate and sustainability page on our website if anyone would like to access more information on that. And lastly, I would like to say a very big thank you to our speakers, Leslie and John, for an incredibly interesting and informative discussion on sustainable investment. Good afternoon, everyone. Thank you.